Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with this Thursday guest, Mr. Jonathan Twomley. How you doing, sir?
I'm doing well, Michael. How are you?
I'm doing great. So one of the podcasts that I listen to every week is a podcast called the All In Podcast. They generally post every Saturday morning. It's about an hour and about 90 minutes usually. Recently, they just had this Miami event where they're posting a lot more details. But the reason I wanted to talk to you, Jonathan, and you haven't seen it, so I'll just set this up.
Yeah.
These are four best friends. They've been very successful in investing. I suspect at least two of them are billionaires, but I think they're all worth $100 million. So
yeah,
legit investors, right? But what they're now saying is basically the last 2 years, all assets, except residential real estate, they kind of did call that out as kind of okay, but they're basically saying cryptos, private equity, stock market, maybe even multifamily commercial stuff, was fueled by cocaine and Red Bull. Basically, it was a party. Risk was zero. Money was free. And they talked about bad investments they made, right? They talked about, hey, we had something at 100 times revenue we didn't sell, and now we lost $100 million. And, basically the last 2 years got people very cocky. Yep. And now everybody's getting their comeuppance and they're seeing down rounds, right? Instacart had a down round. Yeah. A lot of pain, right? I think they mentioned like $9 billion or $9 trillion of wealth has just been evaporated in the last 100 days because everything is resetting. So I wanted to talk to you about multifamily. I think you and I for 2 years have been saying kind of that thing. We didn't use quite the metaphor, but I think it works, right? We've seen some cocaine and Red Bull fueled pricing and it goes to the moon and we're going to have negative rates and cap rates are going to go to 1 and kind of all of these craziness. And they've been winning, right? The party was great while the party was going on. I think the party's over. We've already seen it in crypto. We're seeing it right now in the stock market. Could it possibly come to multifamily and we have a big awakening?
Well, yeah. I mean, absolutely. I mean, come on. Well, listen, you saw the same thing happen in multifamily with pricing. At the end of 2019, we had historically low cap rates, right? Yes. All-time low cap rates for multifamily, right? And people were basically saying like, they just can't go any lower than this, right? And then what happened? COVID hit. And everyone went, oh my God. And so for a couple months, like everything seized up.
Yeah, I remember we all just stopped, right? We're like,
yeah. Everyone just was like, and the banks imposed all of these new restrictions and they imposed all of these, escrows that you had to buy and all this kind of stuff.
Yeah, the banks wanted to slow down because they didn't know either.
And then what happened? Well, all the money that was put out, right?
Yeah.
People were using it to pay rent. Well, first of all, there were people who continued working. They just went home. They worked from home. They continued getting paid and they paid their rent. And then other people got checks from the government and they were able to pay their rent. You did have some properties where, the government said, hey, you don't have to pay your rent now. And so everyone stopped paying their rent. It tended to be the C properties, right? But and a lot of those people, really did lose their jobs because they couldn't work from home. But for the most part, collections stayed high. And then this weird thing started happening where rents started climbing, actually.
Yeah.
Right. And so what that did was it basically convinced a lot of people that no matter what happens, multifamily can't lose, right? It can't possibly lose. And therefore, we're going to pile in even more. Plus, I think a lot of money that was in other sectors, there was a lot of money that was like they usually invested in hotels, right? Or usually invested in office or invested in something else. We're looking around like, well, we're not buying any of that stuff.
Yeah, we're not going over there.
and so they all piled into multifamily or they piled into industrial because industrial did really well because everyone was home and buying stuff, right? And Amazon, was going gangbusters, right? So those are the two categories that really did well. And with low interest rates on top of it, interest rates got even lower, then cap rates went to a place that nobody thought they could possibly go, right? But it's the same exact phenomenon. Like that was a temporary blip, right? That, I mean, I suppose it could have lasted if the Fed continued to
couldn't
have
have lasted forever.
But I'm saying if they kept interest rates low, right?
Yeah.
They just fuel, and then they fueled hyperinflation, right? You could have, I suppose, like people would pour money into real estate just to get away from inflation, but also because rents would be going up so fast and interest rates were so low that they'd pay almost anything to get those properties. But I think what you're seeing now is a little bit of a pullback. There have been some people like posting in my group about the fact that they're seeing cap rates rising. It's slow.
It's early,
right?
yeah.
But frankly, a lot of people don't want to talk about it, right? A lot of people are like almost trying to will the market to continue. So you hear a lot of arguments from people about how, interest rates go up, it's good for multifamily. They go down, it's good for multifamily. They go sideways, it's good for multifamily. Rents go up, it's good. Rents go down, it's good. People stop paying rent, it's great. Like, it doesn't matter what the facts on the ground are. For certain people, it's going to be good for multifamily. And you see a lot of that sort of like desperate, trying to jawbone the market type thing. But I think
that's scared money right there.
I mean, and people who honestly, like, the math is the math, right? Interest rates go up, you have to pay more for your debt service. The banks are going to give you less. There are a lot of people out there saying it won't matter because there's so much money in the sidelines. People will just pay, they'll put in a bigger down payment. No, they won't. And the reason that they won't is because if they can look around and they can say, hey, I can get, 3% to stick my money in a treasury, right? A lot of that money is going to be drawn off, and they're just going to say, well, just stick it there and wait till pricing gets better and then get some bargains, right? So it's going to hit multifamily, and it's just going to be the same story. The people who bought a few years ago will be fine. They really benefited from all this rent growth. The people who are paying at the top and saying, hey, rent growth has been off the charts, it's going to continue. I mean, I'm sure it's going to continue for a while, but I don't think it's going to continue like for the entire length of your hold period. And now you have to also be thinking about what is your exit cap rate really going to look like?
Exactly.
Right? How if interest rates go up, it may take some time, but it will eventually translate into higher cap rates because it has to.
It has
to. The math is the math, right? And like I said, these things are all connected. If multifamily was in a vacuum and it was the only thing that you could invest in, then I could understand the argument that, well, people will just put down more of a down payment, right? That would make sense. However, multifamily is not the only thing that you can invest in, right? There are many other things. And as interest rates will push up, when the risk-free rate of return goes up, the riskier rates of return must also go up. It's just the way things work, right?
Yeah.
So it will draw people into other assets. So multifamily is going to have its own painful moment. Now, crash, probably not, but I think you're going to see softening of pricing.
Well, I think there will be some operators that get really hurt. I mean, I think it'll be operator deal by deal kind of.
Yeah, I mean, if you look, for people who overpaid, it's going to be painful. I mean, if they don't get the rent growth that they base their projections on, right?
Yeah, I actually heard yesterday, sorry to interrupt, I've actually heard from a couple of LPs in the last 48 hours that their general partners have already stopped distributions. Is that the right word? Just like their quarterly payments or whatever they are. Yeah. I heard that. I've heard from two different people.
I mean, I wonder why, because they should be collecting rent like crazy right now. Right. So
I'll follow up. I don't know why. I don't know if they were given a reason. I don't know.
I mean, the only thing I can think of is that they got it over their skis, right?
They had to. They maybe didn't have enough reserves, or who knows what the reason is.
Yeah. They basically just didn't underwrite the deal right? Where they got in and started collecting.
Well, this is exactly what I've been worried about, right? So one of the reasons I speak at events is because I want to know where the group is. I remember in 2019, you can go back and watch my videos. I don't delete anything. I was talking about my greatest fear was I went to a meeting in San Jose. This was pre-COVID. It was 2019. I think there was like 150 people there. So it was a pretty big meetup. So I did my talk, the song and dance, and I took like 45 minutes of questions. More than half the questions were about, hey, I'm a brand new syndicator, never done a deal. What do I do? Hey, I want to be a syndicator. It seems like, blah, blah. I mean, I was like, oh my God.
Yeah.
These people are going to be borrowing money from friends and family. How is this going to work out? And then, oh, by the way, COVID hits and these idiots get bailed out,
Right.
If they did a deal, they certainly overpaid 2019. They were not skilled enough. They didn't underwrite right. But then 2020 happens and cap rates get cut in half. The values explode. They've done nothing right except the bottom line looks good. Now they're cocky as hell and they're going to keep doing it. And they make, maybe they even do another deal and they get out just in time. But now they're sitting they're like, Warren Buffett, what a joke. I'm going to keep doing this. And then they double and triple down. And now they're going to get smoked. It's going to all go to zero.
Well, yeah, I mean, I think that's a pretty typical pattern, right? For people who get drawn in at the top and are not.
Well, they get drawn on this side and then they get bailed out. And then it's like, whoops, I didn't see the elevator down. I saw the stairs. I didn't see the elevator.
But I mean, without knowing more about those particular deals, my guess would be that they underwrote aggressively, they bought, and what they're finding is that their expenses are higher than they underwrote.
Absolutely. And has to be.
And so they're just not making that much money, right? And so, and I think that's the real issue. Like, it's very easy to see where your rents are going to be. It is sometimes, though, it is hard to get the expenses right, or to understand how your expense structure may differ from the seller's expense structure. And I think a lot of people they're not really understanding that expense side of the equation. And then also sometimes the rents are what they are, but collections is another issue, right? And this is one of the things that just always said to people, and because of my own direct experience with this, there used to be this argument that COVID kind of shut this down, but there used to be this argument going around that C properties were great because in a recession, everyone's going to move into C properties because they're cheap. And I always thought that this was the dumbest argument I've ever heard because of a couple of things. One is, like, C properties are older properties, less good neighborhoods, less good schools, less good this, more dangerous, older, whatever. Mm-hmm. People who don't live in those properties aren't going to want to move into those properties unless they have to.
Not by choice.
By choice. But at the same time, the people who are in certainly A and most B properties, they've got some cushion. They can generally, if they lose their job, they can afford to kind of scrape by for a few months till they find a new job. They're not moving, right? They're not saying like, oh, I lost my job, so I'm moving to C. But everyone was always saying this, oh, people are going to move down to C, right? As if it's that easy just to like pick up and leave and move.
It's expensive to move. Yeah.
It's expensive to move also, but also there's a status thing going on in people's minds, right? Which is really important. Or like their kids are in school there, right? Or whatever. They're not just like picking up and moving somewhere else for cheaper rent, right? So this argument was fallacious to begin with, but B, if you looked at the statistics of like who loses their jobs, it's the C-class renters in a recession. Where does vacancy rise? C-class. Even if vacancy doesn't rise, or where your collections problem is happening, C-class, right? It never made any sense. And my direct experience with C-class properties was that even in a very strong environment, very strong economy, you have rent collection issues, right? So the idea that, well, in a recession, you're not going to have trouble collecting your rent on a C property made no sense. I think what's probably happened is that a lot of people have bought these C properties, right? And they're overpaying them. You used to get a really good premium for a C property, a much higher cap rate. The cap rate has basically collapsed. And the idea is, okay, we're going to go in here and we're going to like rehab the whole thing.
That's exactly.
Charge higher rents. And then what happens is you get in there and you find, well, the cost of everything is up, right? Contractors are busy. I can't get this executed. I never done this before. I don't know what I'm doing, right?
Exactly.
And suddenly
it all looks good on a spreadsheet.
Yeah, and then you're not executing on this plan, and you're not collecting your rents, and like the whole business plan is going to crap. So I think that would be my guess as to.
It's absolutely what I mean. And again, this is why I sold 2 of my C-class properties in 19, because again, they were essentially paying Class A for my C, and I'm like, take it. Now that person got bailed out because I actually did go back and look. They sold it. I think they sold it late 21. Might have been January 2022. So they got out in time. But that next buyer, woo.
I mean, I sold my properties in 2019 for the same reason. Essentially, one, the people were throwing these ridiculous offers at me.
Yeah.
Two, I was like, you know what? I'm already having enough trouble collecting rent from these tenants. I don't really want to hang around to see what a recession looks like.
I don't know how to know how this. That's exactly why I sold. I thought a recession was coming in early 20 before.
Yeah, and I think we were both right. Like I said, we've talked about this before too. There probably was a recession starting at the end of 2019, early 2020, but COVID just overwhelmed everything.
Yeah.
So you couldn't. So that the data was lost, but or it got swamped by what happened with COVID. But sure. I think we were both right to call at least a mild recession in that time frame, and getting out was the right thing to do. And you couldn't have predicted that it would go nuts. But I know, for instance, that I was here. I haven't checked to see what happened with those properties I sold, but I was hearing reports from like my old property manager and stuff that they were getting citations because they weren't I guess they'd slashed their garbage haulage frequency because they were trying to
nickel and dime. Yeah.
Yeah, because they paid so much for their properties.
Yeah. Really close to the bone if you're shrinking your garbage pickup.
Yeah, seriously, it's not that big an expense, right? But if you're doing that, then
it tells you how bad you're.
But who knows? If they sold, they probably did fine. They probably made a lot of money. If they turned around and sold it a year later.
Yeah. So I think there's going to be a lot of pain. Again, I thought the whole analogy or metaphor of cocaine and Red Bull made sense. I think in multifamily, it was definitely fooled by cocaine and Red Bull. And if you left the party before the cops showed up, you made a lot of money. But a cocaine and Red Bull party generally creates bad behavior that reinforces bad behavior.
Yeah.
So I know a lot of people that were at that 2019 San Jose event did a deal and it worked. And then they got really loose in their underwriting, and it's probably going to cause a lot more pain. So Jonathan, where can people find you if they want to know how to do this the right way?
Sure. Well, if you would like to get on my investor list, please go to, you can Google Two Bridges Asset Management LLC and fill out the form there, as many of you have. So thank you very much. You can join my free Facebook community, which is called the Multifamily Investment Community, and get in on the conversation. And then finally, if you are interested in learning how to do this, you can go to multifamilylaunchpad.org/join and join my coaching program.
Awesome. Thanks, Jonathan.
Thank you.